There's been a lot of chatter about the Federal Reserve recently, and it's only going to heat up in the coming months. But what exactly does the Federal Reserve control? What the Federal Reserve controls is what's called the federal funds rate. This is the rate at which banks lend money to each other on an overnight basis. And the reason they're lending money to each other on an overnight basis is because they have financial reserve requirements based on the number of deposits that they have that they need to keep in their bank. So if they have a shortfall at the end of the day, they can borrow money from another bank. If they have a surplus, they could lend money to another bank. And that happens at that Federal Reserve rate. So essentially that Fed funds rate is the cost of money in the system. So if the federal fund rate go up, then the products that that bank is lending out to customers, such as credit cards or auto loans or other short-term products, those have to go up in response to that. Or if the federal funds rate goes down, then those products' interest rates go down along with it because they're short-term products. Now for mortgages, on the other hand, these are not a short-term product, so they don't follow the Fed funds rate directly. What they follow more closely actually is the 10-year Treasury. And the reason that they follow the 10-year Treasury yield is because whenever mortgages are taken out, they might be a 15 or 30-year mortgage, but by the time it gets refinanced or paid off, or the house gets sold and the person moves, that's typically on average around that 10-year mark, which is why it follows the 10-year Treasury most closely. So whenever banks sell a mortgage, they're typically not the ones that are going to hold on to that mortgage throughout the life of the loan. What they're going to do is package that up with thousands of other mortgages, and then they're going to sell those off to investors as mortgage-backed securities. Now, since these mortgage-backed securities are taking on more risk because people could just default on their mortgage or they could pay it off early, which means the investor loses out on the interest, the investors are going to demand a higher interest rate compared with the benchmark, which is the 10-year Treasury yield. So if I'm a bank that's looking to make a mortgage and the 10-year Treasury is currently sitting around 4.5%, I'm probably going to charge somewhere around 6.5% or 7% for that mortgage in order to be able to sell that to an investor, because the investor is going to want a spread on top of that benchmark for that additional risk that they're taking on for buying that mortgage-backed security. So whenever you start hearing about the Federal Reserve cutting rates, which is looking like they probably will here in September, don't expect to see a one-to-one drop in the mortgage rates whenever they do that cut, because there's all these other factors that are impacting mortgage rates, like the 10-year Treasury.